Welcome to the Deep Dive. Today, our mission is to cut through the complexity of the Q3 2025 earnings call for AST SpaceMobile, ticker ASTS.
That's right. This is the company building that space-based cellular broadband network, the one that connects directly to, standard mobile phones.
And this report, which came out after hours on November 10th, it was arguably the most anticipated in the entire space sector. We're going to dive deep into what these numbers actually mean.
And the initial reaction was just a fascinating thing to watch. The headline results were objectively a miss, an across-the-board miss.
Yeah.
And yet the stock was surprisingly resilient. It closed the next day down just, 1.2%?
Barely a blip.
Exactly. And that muted reaction tells you everything. It says that investors are basically ignoring the current P&L. They're looking right past it, and they're focused on the strategic story, the commercial deals, and the balance sheet.
Okay, let's unpack that financial miss then, because you're right. On paper, it looked rough. If we just look at the GAAP earnings per share, that was a loss of 45 cents.
Yeah, -$0.45, which was a pretty material miss. The street was expecting something closer to the $1.30 range.
And the revenue side told a similar story.
It did. They brought in $14.7 million. The analyst consensus was, somewhere between about $19.9 million and $22.2 million. So, yeah, a miss.
For a company at this stage, any revenue miss like that feels like a red flag. But you're saying there's more context here.
There's vital context. While it missed the estimate, that $14.7 million number, it actually represents massive growth. It's a 12,236% increase year over year.
Wow, okay.
A year ago, they did just $1.1 million. So this number, as small as it is, marks the beginning of their commercial ramp. It's coming from gateway hardware sales and hitting milestones on their U.S. government contracts.
So the question for you, the listener, is what do you focus on? The short-term miss, or do you look at it like a growth stock and focus on those future contracts?
And that's the perfect pivot, because management's narrative on the call was completely detached from those financials.
The CEO said commercial activity has, and I'm quoting here, significantly accelerated.
Right. And then they dropped a number they've never disclosed before. Over $1 billion in aggregate contracted revenue commitments from partners.
$1 billion. That's a huge figure.
It's the functional offset to the financial miss. The market sees that number and it validates the whole thesis, right? It says the product is needed and that future revenue is, it's locked in.
And these aren't just handshake deals. They announced definitive agreements with some huge players.
Two giants, really. Verizon in the U.S. and the CES Group, which covers the Middle East and North Africa.
So let's start with Verizon. What does that agreement do for them?
The Verizon deal is purely strategic. It's crucial because it positions ASTS for 100% geographic coverage across the continental U.S.
Yeah.
It gives them a near nationwide footprint right from the start, piggybacking on one of the biggest mobile networks in the world.
And the CES Group deal might be even more important in the short term, financially speaking. It's a 10-year agreement.
And the key part is the prepayment. A $175 million prepayment that ST Valley is set to deliver by the end of 2025.
So how does getting that kind of non-dilutive capital change things for them?
It's transformative. Non-dilutive is the key word. They don't have to sell more stock to get that cash.
Right.
That $175 million just shores up all their launch costs and manufacturing expenses for the next few quarters. It takes a huge amount of risk off the table.
And this is all part of a much bigger picture. They now have agreements, or MOUs, with over 50 mobile network operators.
50 MNOs. And when you add it all up, that covers nearly 3 billion potential subscribers around the world.
So they're going global fast.
Very fast. Look at Europe. They announced an intention with Vodafone to set up a Europe-led constellation, an operations center in Germany. They already have MAUs signed in 21 of the 27 EU member states. This is a foundational global build-out.
And that commercial foundation, backed by the billion in commitments, it leads right into how they've totally fortified their balance sheet.
The CFO's presentation was really a masterclass. Pro forma liquidity, so that's after factoring in all the new financing, stands at about $3.2 billion.
Which is a massive jump from the $1.2 billion in cash they had on September 30th.
A huge operational buffer. And this led to the single biggest headline from the call.
The quote that the company is now fully funded to build and launch a constellation of over 100 satellites for worldwide service. We have to stop and analyze that.
We really do, because their previous target, which was already ambitious, was to be funded for just 45 to 60 satellites.
So they basically doubled it.
They more than doubled the funded target. Jumping to over 100 satellites signals an insane level of internal conviction. It tells you they believe they've cleared the core technology hurdle in their trial.
So they're not just testing anymore, they're betting on scale.
They're betting the farm on scale and speed. They know that only a large constellation can deliver that continuous global service they've promised.
And that conviction is all backed up by the financing they got. They raised $1.15 billion through 10-year convertible notes. For anyone not familiar, why are the terms here so important?
Because they just scream confidence. First, the coupon, the interest rate, is incredibly low, just 2.00% for 10-year debt. That means the capital providers see very low risk.
And the conversion price?
That's the real story. The effective conversion price is around $96.30 per share.
Wait, $96? The stock is trading way, way below that. What does that imply?
It implies that the sophisticated investors buying this debt are betting the stock will eventually trade north of $96.30. It's a huge vote of confidence, a de facto anchor for the long-term bull case.
And they also cleaned up the balance sheet a bit?
They did. They reduced their old, more expensive converts down to just $50 million. So the whole capital structure is now fortified for the next 3 years of pure execution.
Okay, so they have the cash, they have the contracts. The whole conversation now shifts to, can they deliver?
Exactly. It's all about operational execution. And the market is laser-focused on their guidance, especially after that Q3 miss.
They reiterated their second half 2025 revenue outlook of $50 to $75 million.
They had to. After missing Q3, market confidence is now completely hanging on them hitting that Q4 number.
And expenses are going up, which is to be expected, I guess.
It is. Adjusted operating expenses rose to $67.7 million. Management said it's because they're scaling up engineering and gateway deliveries. They're moving from R&D to a real manufacturing and deployment cycle.
And that scaling means higher CapEx. Q3 was $259 million, and the Q4 guide is for $275 to $325 million. What's driving that quarterly jump?
It's pretty simple, actually. It's the timing of launch payments. When you're getting ready for this kind of deployment, the cash goes out in big chunks.
Which brings us to the launch timeline. This is the single biggest operational risk, right?
It is. So let's lay out the cadence. The near-term targets are very concrete. They confirm Bluebird 6 has already shipped to the launch site in India. Bluebird 7 is about to ship to Cape Canaveral. And the critical target they have to hit is 5 orbital launches by the end of Q1 2026.
So 5 launches by the end of next March. That's a firm scheduled target.
Not a vague projection. And beyond that, the midterm goal is to have between 45 and 60 satellites up by the end of 2026.
And hitting that number is what allows them to actually start the continuous service they've sold.
It's non-negotiable. That's what's needed for continuous service in their key launch markets, the US, Europe, Japan, and Saudi Arabia. If they miss that, the revenue ramp gets delayed.
Let's talk about the tech on those satellites. They mentioned a new ASIC chip, the AS5000. For our listener, what is an ASIC and why is it so important here?
So ASIC stands for Application-Specific Integrated Circuit. It's basically a custom-built computer chip designed for one specific job.
And this one's job is?
Its job is to process a massive amount of data. Integrating the AS5000 is critical. It enables processing up to 10 gigahertz and peak data speeds of 120 megabits per second. Without that chip, the satellites just couldn't handle the traffic.
And their real competitive advantage, their moat, as they call it, is their spectrum strategy.
That's the genius of the architecture. It lets them stitch together different slices of spectrum from different partners like AT&T and Verizon.
So they can combine them into one seamless network.
Exactly. They confirmed they're using AI engines to manage all of this dynamically. The system just instantly optimizes which frequencies to use, where, and when.
And when you combine all that spectrum, what does it give them in the U.S. alone?
Over 80 megahertz of paired high-quality spectrum. In this direct-to-device space race, having that much bandwidth is like having a private 10-lane digital highway. It's a massive advantage.
Okay, so you have analysts at Deutsche Bank and Roth with these bullish price targets, $81, $82.50. You have the convertible debt priced at an implied $96.30. And yet, the stock barely moved. How does the street square that circle?
This is just the classic show-me story. The sell-side analysts are looking at the long-term contracts and the fortified balance sheet.
A long view.
The very long view. The public market, though, is focused entirely on execution proof. Right now. Investors need to see them hit that Q4 revenue guidance, and more importantly, they need to see those launches go up on time. Any slip in that Q1 2026 cadence will get punished, and punished heavily.
So the critical catalysts for you to watch are pretty clear.
Yeah.
Those 5 launches by the end of Q1 26.
Absolutely. Then the initial service activations in early 2026. We should see intermittent service pop up in the US, Canada, Japan, Saudi Arabia, the UK.
We also need to see more detail on that new U.S. government award they mentioned.
Before we move on, just think about this. The CEO now says they're funded for a 100-plus satellite constellation. That is a dramatic jump from 45 to 60, with the huge jump in CapEx. What does that level of aggressive scaling tell you about their internal confidence? They are not inching forward. They are pouring $3.2 billion into this, which suggests they believe the fundamental tech risk is already solved. They're just betting it all on speed and scale now.
That level of conviction does set the stage for a, shall we say, a high-leverage trade idea. But first, our most important disclosure.
Yes, this is not financial advice. We are simply talking through a plausible, though extremely aggressive, strategy based on what was disclosed.
And the binary nature of the risk here.
Exactly. You have this binary execution risk tied to those Q1 2026 launches, butting up against that very attractive $96.30 implied conversion price.
So what's the thesis for a trade?
The thesis is simple. If the launches are successful and they start hitting that revenue ramp, you'll see the execution risk just evaporate. That could trigger a massive short squeeze as the market rushes to close that gap toward the $96.30 end price.
And how would you structure a trade to play that?
Well, to get high leverage, you could implement a risk reversal. Some people call it a synthetic long stock position.
Okay, can you break down synthetic long in plain language for us?
Sure. You're basically funding your upside bet by selling downside insurance. The strategy would be to sell near-term, out-of-the-money put options, maybe expiring in Q2 of 2026.
So you collect a premium for that.
You collect the premium, and then you use that cash to buy longer-term, deep-in-the-money call options, maybe expiring in Q1 2027. You take on risk by selling that put, but it lets you control a long position over that critical launch window with maximum leverage.
It's a bet that execution will justify that $96 confidence price. A pure conviction trade.
A conviction trade indeed.
So to quickly recap this deep dive, Q3 was a story of financial misses completely overshadowed by huge strategic wins. We're talking $1 billion in contracted revenue and enough funding to target over 100 satellites.
And the focus now is 100% on operational execution, Q4 revenue, and most importantly, the launch cadence through the first quarter of 2026.
Remember, all the information we talked about here is based on the company's public filings and earnings call.
We're not endorsing any specific investment strategies. You should always, always perform your own extensive due diligence before making any decision.
Absolutely. Thank you for tuning into this deep dive. We hope this saved you time and got you smarter, faster. We'll catch you on the next one.